So I want to repeat myself. Welcome to week 2 and module 2 in Advanced Principles of Financial Management. And what we're doing here is what our objective here is to in module 2. In module 1, we looked at how to value equities and an introduction to the class. And hopefully you've gotten your work done. I've graded it yesterday. I did send out a message for those of you who haven't completed it, and I realize we're in the summer and some of you may still be getting your sea legs. Let's try to get everything done. It's really important that you get up to date. Extremely important. So I sent that message out. Please pay attention to that. I will definitely work with you, and I'm not looking to penalize people for being a little late in the first week, but you have to get that work in, and you have to participate in the discussions to get full credit. It's an important part of the class. So please make a note of that. But at any rate, I realize we're still in the summer, but you got to get in there. As time marches on, and education is important. We all know. And this is a great class because I generally speaking, as a professor, I learn as I teach. And in Rasmussen, they pre-populate the classes, and it really is a good experience for me too because they've done a great job with this. Okay, so I can't complain. They really put together a nice program. So long story short, what are we talking about in module 2? So I'm going to share my screen, and we're really talking about the bond market. And what's the bond market? The bond market are tradable loans. So either the company, the government, or municipality, or any entity like that will issue bonds. And these are basically IOUs. So the investor will buy the IOU by giving the company money. So let's say the company's paying 5% or the government's paying 5% for 10 years. And you as an investor or a mutual fund or any type of person with capital that is looking to invest and earn interest will buy these bonds. And they trade in $1,000 increments. But you could buy billions of dollars. I mean, professionally, that's what I did. I was a bond trader. But you can buy billions of dollars of bonds or millions of dollars of bonds, but you buy them in $1,000 pieces. The same way when you go to buy gasoline, you buy them by the gallon. Or you buy milk, you buy it by the gallon, or a loaf of bread is a loaf of bread. It makes it homogenized. Even the contracts behind the bonds, which are called indentures, are basically boilerplate. Just like you expect when you buy a gallon of milk, it's a gallon of milk, and you don't have to think about what's in there. It meets all these FDA requirements, and it's in a certain kind of, in that little jug, and it actually has that little, I just learned, I didn't even knew this, that little circle that's in there. Anybody know why that existed? It exists because if it ever pops out, it means the milk has gone bad. So that's why that little circle in the plastic jug is there. And if you look at it next time you go to the supermarket, look at the jug of milk, and then you'll see, you got that gallon container, and somewhere in the middle there's a little like circle that goes in. It's sort of like indented. And if it ever pops out, you got to get rid of the milk because it's sour. I guess the gas has expanded it, and that's a signal to the consumer that you've got bad milk there. But it's not buttermilk, right? Buttermilk is sour. My grandmother, she rest in peace. She lived with us, and she raised me. She was a big baker, and if you know anything about baking, buttermilk is something that goes into a lot of the cookies and cakes and stuff like that. So that's a little aside. So the bond market really works like that, right? The bond market really works like that. And the beauty of the bond market is you give them, say, $1 million in $1,000 pieces, and everything is done now electronically, and you get a statement. Years ago, you actually got a bond. Let me share my screen. Years ago, you actually got a bond. You actually received. There were bonds trade. There were bonds out there, right? It'll look something like this. Now it's just a paper entry, right? Let's see if we can find one. Here's an image of one. There you go. There's one. I noticed this was the Marietta Pittsburgh Cleveland Company. And notice they have these little coupons on the bottom. And that would mean that if you bought this $1,000 bond for 5%, well, every 6 months you would get a check for $25, which would equal you 5%. So that's how the bond market works, right? That's what a bond certificate looks like. That's why we call them coupons, because people actually took the coupons off and they brought it to the bank, or they brought it to a brokerage house, or the brokerage house did it for them, and they actually gave them their money. And then at the end of the period, 5 years, 10 years, however long the bond exists, you receive your money back, as long as the company or the issuer doesn't go bust. The US government is considered the safest borrower, right? They're the safest borrower because they, our military, our economic system, our ability to continue to pay our bills make us the safest system. So most US borrowers will borrow of a rate off of the US 10-year bond, which is what we call the pure rate of interest. Now, right now it's trading at 1.28%. That's where the government borrows money. Or if you gave the government money for 10 years, you would earn 1.28%. And it's also a function of inflation, right? If inflation is not growing, then it's a pure 1.28%. But if prices are going up 2%, then you're actually losing money by giving them money because you got negative rates, right? You have to make up the cost of living. So if your cost of living is going up 2 or 3% a year, and depends on your cost of living. I mean, we have a cost of living index, but if your cost of living is going up 2 or 3%, you're only earning 1.28 from the government, you're actually in a negative situation. But if inflation is at zero, well, then you're making a positive return. So really, the true rate of return on a bond is your actual rate less your inflation. So try to keep that in mind. But again, going back to our work this week, if you're doing your readings, and you must be doing it, hopefully, I mean, you have to do your readings, you will see that, and this is module 2, that in your overview of activities, you have to read these chapters, and you'll get the stuff from these chapters. Plus, I can't urge you enough to go to my YouTube channel, and you can watch the videos, and I've already put this down on time value of money, which is how we figure out bond prices, and we'll get into that in the homework. And Federal Reserve System explained, and how the Fed moves interest rates, and the nature of bond valuation. So I can't stress it enough to go ahead and watch some of my videos as an addition to the work we're doing, because it's going to be more, it's going to further illustrate it, and you're going to get additional learning, a class time, basically, because I've created these classes and I've created these YouTubes so you could benefit from them. Also, if you go to the Rasmussen playlist, you can actually go back and see some of previous classes I taught here and watch some of those videos. So you see another take on how I teach this class. So you've got a couple of different takes on how I teach the class, okay? So please feel free to go ahead and do that. No problem at all. And I urge you to do it. You got bond price calculators and on and on. So that is so that's kind of a prelude to how bonds work. In week 2, what I want you to do is read those chapters, right? And one last thing I want to talk about when I talk about bonds, you're borrowing money. So if I'm funding, and that's what this unit is sort of all about. How do I finance my growth? How do I finance my company? Do I borrow money and take on partners? And if I do that, what I'm saying is, well, I'm borrowing money, I'm taking on partners. If things work out, we all make money, and if things go bust, we all lose. The prevailing thought, and we call this signaling theory in finance, is that the markets might say, well, why does this company want to sell more equity? Generally speaking, when a company funds its growth with more equity, and this is called the pecking order theory, means there's a pecking order of how you should finance your company, the markets might discount the equity and charge the company more, or force down the price of the equity so they get a better deal, because they're afraid that if the company was doing well and they assume that the managers know more than they know, then they wouldn't want to take on partners, right? If you had a good deal and you could finance it by borrowing money or taking on equity, and it was a good deal, you would presumably borrow the money. Why take on equity? Because when I borrow the money, yes, I have to pay interest, but all the profits are mine. And I actually leverage my profits because I can invest more money. It's like when you buy a house. If you think the house is going up in value, well, you're going to want to put the least amount of money down and take on the biggest mortgage because you're going to get more profit on the way, right? If I buy a $500,000 house and I put up all 500,000 and the house doubles in value, I make 500. That's great. But if I only put down 100 and borrow 400 and make 500, I've made 5 times my money, and I can buy more house too. I can buy 5 houses, presumably. So the power of leverage, right? So in the pecking order theory, the least desirable way to raise money is equity. The second would be taking on debt. And the third would be just funding it through your own profits. because retained earnings, because then you don't have to worry about signals. So I put that on the side, but it's something you want to understand as a manager, and these are all transferable skills that you can pick up. But going back to the bond market, one of my concerns would be with the bond market is that, well, not concerns. What happens is if you hold this bond that's worth 5%, say a 5% bond, and rates go up to 7% for comparable bonds of that class, because corporations and governments are going to pay more than the U.S. government. The government's paying 1.28. A corporation, a good corporation, probably pay 2%. A corporation that has some issues might pay 4 or 5%. And it's all according to the ratings, which you'll learn more about in the readings, right? Corporate ratings, they go from A to kind of D, and they're just like credit ratings. So if a company is not doing well, they're going to get low ratings and have to pay higher rates. Like you would have to pay higher rates if you didn't have a good credit rating. But at any rate, if you're paying 5% and everybody else is getting 7 for the same kind of bond, your bond is going to be worth less. Because one of the things about the bond market is you could trade it, right? You could trade these bonds back in the market. You can trade them back and forth. You can get out of them. That's why that's why the bond market is so efficient. It creates liquidity, right? Liquidity is key. So if the bond market goes 7%, right, and you hold a 5% bond, it's obviously not worth as much because everybody else is getting 7. Now they can't adjust the coupons. But what they can adjust, is the they can't adjust the coupons, but what they can adjust is the principal piece, the 1,000. And we're going to learn when we see time value of money. We'll learn the math in a minute, but it'll be worth less. You'll get less because maybe you'll sell it for $900. And at the end of the 5 or 10 years, at the end of the period, the difference between the $900 that the buyer paid and the 1,000 they get in at the end, plus the coupons, will equal the more enhanced rate mathematically. And obviously, it works the other way around. If rates go down and you're holding a more expensive bond and you decide to sell it early, you're going to get more money on the principal piece because those buyers will take the loss versus the coupon and get the same rate. It will always equal the same rate. So, and then there are other calculations that are more advanced, like duration, which tells us the effective life of the bond. And to be quite frank, the Bloomberg gives us a lot of information. On this stuff. That's why people really like the Bloomberg. Let me see if I can call it up. I hope I can run both things at once. I don't want to get ahead of myself here. But let me just take a look. Bear with me for a minute. Okay. I mean, this is a pretty powerful computer, but let's give it a shot. It's something I really want you to see. See if we can get this going. Okay. Text. Let's see if I can do this. Bear with me for a minute. Okay, so I'm going to run the Bloomberg in the background if this works. See how strong this computer is. Just bought a new one right in the beginning of the year. Do a lot of work. Let's see if we can get this thing launched. All right, so we got this going too. It looks like we do. Let's see. So we're going to we got the Bloomberg up here too. So we'll get an idea of how bonds, we'll talk more about this, but this is basically the book. Right? And this is, I use this professionally and it's been great. And it's really the as much as Bloomberg, all the different things it does, what it does most efficiently is it deals with the bond market. So for instance, this is one of the functions, and notice you're getting all the current rates as they trade the Fed funds rate, the different T-bill rates where the government borrows money, different deposit rates, repos, or just financing vehicles professionally. You get U.S. bonds here. futures markets. There's a lot here. And then you even get economic releases, which are going to affect interest rates, right? If you watch my video on the Fed, and here are all the key rates that you're going to see, right? And even overseas rates, like the Japanese bond market, the European bond market, the Europeans with the euro, where you borrow in euro-denominated bonds. And here are the different bond prices for different lengths. So once again, if we go out 10 years, we're going to notice we're in 21. So if we go out 10 years to 31, let's see, a yield of 1.28%. Go back to our computer, we're going to notice that there's your 1.28%, almost exact. So we'll go back to Bloomberg in a minute, but that's kind of cool, right? And the Bloomberg does so much. I mean, it's just an amazing tool. Fortunate to have it. You can even look at things like world equity indices. These are all the different indices throughout the world and where things are trading. Different volatility and stuff like that, which we'll do more. Now that this stuff works together with our little class here, I'll call this Bloomberg up from time to time to give you a feel for how to look at this stuff. It's really interesting stuff. All right, so let's keep moving. Let's go back to our class. And so you got a pretty good idea, hopefully by now, how the bond market works. Bear with me for a minute, because this little ribbon keeps coming down. So this is this week's work, and like I said, you have to take care of those activities. And one of the things I want to go over, that I don't want to waste too much time, is the course project for this week. So the course project is really interesting because you're dealing with this, which is new for you. This is allowing you to put together a presentation, and those are good transferable skills, right? And so this week I offered, and if you look at your work, close this for a minute, you're going to see that I also put in a example for Gentry. So if you just click on that, you can download the example. And that'll give you an example. Now, it's not meant for you to plagiarize, obviously, but it's meant to give you a guide as to how to do this project. So let's take a look at it. So I'm going to call this up. It's me. And that's what it is. It's growth and expansion strategy. That's a real good example of a growth and expansion strategy. So this week, you're going to discuss whether we should expand it to China, Japan, to Germany, or all at once, and how we're going to fund this thing. And as I said, equities are the least desirable because we're signaling that we're not too confident in the company, theoretically, academically, or bonds might be another way to go, or obviously retained earnings is the best. So this growth strategy, this is a good example. We could borrow from a bank, we could sell stock, we could sell bonds, or we could use our retained earnings, which really preferably I would like to see that answer too. So the first part, we explain what that is. And what are the advantages and disadvantages? Well, it's a very good job here. Bank loan might be strict covenants to follow. Right? So when you go to a bank, it's really borrowing. You're doing the same thing you're doing in the bond market, but you might have the issue of the bank giving you very strict covenants, right? It's like when you borrow any money from the bank. They may say you can't do certain things. You can't take on too much leverage. You can't go into new projects. And that's going to kind of hamstring the company. So that may not be, plus, and a good point, a bank can have variable interest rates as opposed to a bond that's going to have a finite interest rate, like 5%. A bank might move with the prime rate, right? A bank might tee its rate off the prime rate of interest, right? In which case, if you're dealing with the prime rate of interest, which is right here, 3.25%, well, as the prime goes up, you might have the issue of having to pay higher interest rates. So you're going to have a variable interest rate cost, which is not a good idea. Not, unless it goes down, in which case that would be good. But you may not want to give your investors that risk. And bonds have fixed rates. So this is a good example of how to put this together. When you look at selling stock as an option, you can see the advantage of that would be that there would be a note to pay back. Instead, Gentry pay out dividends based on how well they are performing. So another good point. You don't have to pay back the note. You just have to pay, and you're not liable. No company has to pay dividends. Dividends are totally elective. So let me point that out. But it's a good point because there's no debt and there's no. It's just like borrowing money. Borrowing money allows you to leverage your profits. Borrowing money also gives you an obligation that you have to meet, or you go bankrupt. So these are all good points that were being made in this particular thing. And obviously, anything you do has to be passed by the SEC. And then, so what are the global expansion strategies? Develop entry and exit strategies. Use an agile approach, which means you could pivot. If things aren't working out, you can make different moves. You can do different things. You're not tied to this. And do your market research. And select a global hiring method. Generally speaking, hire local talent, partner up, all really good ideas and all really good examples. I would also urge you to use an international bank like Santander or Citibank or Union Bank of Switzerland, because they have international bankers and they have contacts in every country. And you have to think about political risks. You've got to think about currency risks. You have to think about hiring and legal risks. So with good attorneys and a good overseas bank, they're going to kind of shepherd you through that process if you're looking to if you're looking to increase your profitability overseas. And then finally, a recommendation. And then references. References are important, and this paper does a good job at referencing. So there you can call it up, and that's a great example of what you need to do in Gentry. Okay. It's on your. So let's, the key word this week is ocean. The key word this week is ocean. And if, by the way, if we call it module 2, they want you to review this article on Starbucks and watch the video. So you'll get a good idea. I'm not going to go through it with you. Obviously, in conjunction with my YouTubes, you're going to get a good idea of how Starbucks does its growth strategy and how it grows and it identifies sources of sales growth. You have to watch that. And then, of course, imperative, you can watch my video on time value money. I also expect you to watch this video on time value. So there's a good example. Excellent stuff. So I expect you to read the chapters and go through all of this. Keyword being ocean. Okay, so let's look at let's take a look at this week's homework for a minute. And again, I expect you to do your own work. But XYZ, let me give you a few examples, has issued a 30-year bond with a 6% coupon rate. Right? So this is what I was talking about before. We have a 30-year bond with a 6% coupon rate. If the market is yielding 7%, what's the selling price of the bond? So we know that we own a 6% bond that pays 6% a year, but the markets are actually giving us in the same kind of bond 7%. So we know we're going to take, right off the bat, you should know if you're watching at home, that we're going to take some sort of discount on our principal piece because people are going to want the difference, right? So in this piece, we put 1,000. And remember, when you deal with Excel, you have to either put the percent sign or write it as 0.06. I want to be very clear on that. When you put a percentage in Bloomberg, it's either got to be expressed as 0.06 or you have to add the percent sign. Must do that. If you just write 6, you're going to get a bad answer. It's got to be either 0.06 or 6%. And there's your coupon, $60. There's your maturity, and there's the current rate of interest. Notice this was done with 0.07 and 0.06. And then all you need to do is call up the present value function, which would be the present value of D8, the rate, D7, the maturity, D6, the coupon, and you're going to get a present value of the coupon, and then you're going to do the same thing with the principal piece. And that's going to give you the answer on an annual basis. And this was an annual basis. Now, that bond will be worth $875.91. And notice it's worth less because the buyer of that bond will realize the difference in 30 years of $1,875. They'll make $125, $126 profit, and the difference will equal the 1%. So they'll get that 1% back. Okay. That's the principal piece. You could do it this way. I'll show you another way to do it. Call up formulas, present value, the rate's 6%, number of periods is 30. If you want to do it as one calculation, you could put in the payment, which is 60. You could put in the future value, which is 1,000. It's going to be 7%. Put 7%. So I put 7% in there. Notice I put the percent sign. Number of periods, I put these 7 or 30 years. Let me just write it out for you to make it easy. I put 30. The payment has got to be my coupon, which is 60. And my future value is going to be 1,000. Right? So I put in all those numbers and I click OK, and I get the same number. That's what the bond's worth. That's all you need to do. It's a time value of money function. This was a nice little example because we broke it out. If it was in this case, if it's a semi-annual bond, right? So we got 6, market shielding 8. Obviously, there'll be a bigger discount, but it's a semi-annual. It pays twice a year. So you wouldn't want to just do annual. How you adjust for that is you divide the rate by 2 and you divide the periods by 2. And you adjust for the additional compounding. You were doing quarterly, you would divide by 4. By way of example, I'll do it for you here. I'm going to go to formulas. Now you can just go, you can find these formulas on the finance. Once I know 4 of the variables, I can solve for the 5th. I'm going to go here, present value. Now my rate is, my current rate that I'm solving for is 8%. So I'm going to put in 8%. Remember the percent sign, or 0.08. But I'm divide by 2 because it's semi-annual. It's twice a year. Now my number of periods is going to be 30. The 18, or I'm going to write it 30, but I'm going to multiply by 2 because I'm doubling. If I divide, I have to double the periods to get the right number. My payment is finite at 60. And once again, my future value is going to be, I'll make that 60 so you can see it. And once again, my future value will be 1,000. Something. Divided by 2. So I have to take my payments and divide by 2 because it's a semi-annual payment. But the last value will come out to be $1,000. So when I hit OK, notice it's the same number. But here we break it out by doing it as 2 separate entries. Okay. So again, I'm not going to include this because I don't want to give you the homework. I want you to do it yourself. This is how you would do it. If you had to solve a future value, then what you need to do is call up formulas, financial. You got to solve for the future value. So when I solve for future value, I'm going to say the equals future value, which is another way to do the formula, is D29, which is the coupon, D29, which is the rate of 4%. This should be rate. D29, which is the rate, D31, which is the 15 years. D30, which is now the coupon or the actual coupon, and D28, which is the price we're paying today, which is the price we're paying today. So if I pay $950 today and I'm earning 4% and I'm getting my $1,000 back at the end, what's really my true value when this is all said and done? What's my total return? What's my total value? Well, we can do it again by going to formulas recently used, future value. We could say we got a rate of 4%, got the number of periods of 15, got a payment of 40, and this time we got a present value of 950. I'm going to make that a negative, only because this way it comes out positive. When you put a negative for the present value, you're going to get a positive for the future value. Sorry. Yeah, that's the way you do it. You put a positive there. Okay? You don't want to do that. Okay? Finally, we have a couple of others. If we issue a 30-year bond with a coupon rate of 8% and a future value of 1,000 and the market rate's 9%, what's the current market price? Well, now we just have to solve for the present value again. So the rate's 9%. That's the market rate. It's a 30-year bond. It pays an $80 coupon, and our future value would be 1,000. So our present value, our current value would be 897. So again, somebody who's getting an 8% coupon, but the market's actually paying 9%, is not going to pay the full 1,000. By paying 897, as I explained before, the difference at the end of 30 years would be 897 less the 1,000, so that additional $103 profit over 30 years. You have to wait 30 years to get the money, but that will make up for the 1% difference. Okay, and the last one you could do on your own. But that's the way to do these. So if you watch this, you've got a pretty good handle on what the right answer should be, but I expect you to do it and do it yourself. Get it right, okay? That's why I'm going through it. So basically what we're seeing is the bond market is a time value of money proposition. And the markets adjust for rates. So there you go. Now going back to the Bloomberg, I'm so glad I have this. Let's search for a bond. Why not? So we called up this treasury bond. Bear with. Equity markets. Let's look for a quote here. And there's the treasury bond. So it's the 1.25% of 815.31. It's a government bond. And you could search for corporate bonds. You can do whatever you want here. You could put in a spread over treasuries. Here it's going to be 0. There's your price, right? Rates are a little higher, so the price is a little lower. There's our yield, and you can look at yields to worst or yields to maturity, which will be the same. And really, when they say yields to worst, sometimes bonds could be refinanced earlier. Sometimes bonds could be refinanced earlier, and that's a called bond, like you could refinance a mortgage. So you're going to get a different yield if we do the yield to worst. Here's the settlement date with the bond today. This is really a good system for traders. And there's your duration, which I talked about, but I don't want to get into too deep with it because it's a much more complex calculation, but it's really the effective life of a bond. Okay? And it gives you kind of, because it's a government bond, it gives you a comparison with other bonds, the like bonds and government bonds. And there's the different spreads over treasuries. If you click on that, you see what the different spreads are. We don't need to get that deep into it. And, um, and again, this is the duration of the bond. It would be a 9.3 year bond effectively because of the discount that you'd be paying. That's basically almost 10, and then this would be, if you were to buy it, what you would have to pay. Because again, I'm not gonna get too deep into it, but you have to, if you own the bond, you collect a coupon, right? Like, let's say you own the bond, bond pays a coupon in 6 months, but you've owned it for 3 months and want to sell it. Somehow you have to be compensated for those 3 months of coupon. The buyer will pay you the principal amount, whatever it's trading at, in this case, 99 and 23 3/4, which is a function of, it's like 99.23, 99, like 2/3% of par. No, 99 1/4% of par, so you pay like $992.50 per bond, but you would exchange coupons, so the buyer would give you, um, the buyer would give you the 3 months that you earned. Then at the end, they'd collect the 6 months, because they're the ones holding the bond, but you'd get compensated for the 3 months. You don't have to get too deep into it. The description here, if I click on description, I'm gonna get the description of the bond, different yields, using, and what this is we have different types of ways to calculate yield. Mathematical, and if you take advanced finance down the road, you'd have to learn this stuff, but you don't need to know it now. I mean, notice they're pretty close. With bonds that are more risky, you might see a different, more of a spread here, also more of a difference on duration. And there's pricing. So this is a great example. You normally wouldn't have this, but I'm so grateful I have this. And these are the different dealers, the street, that are trading these bonds. Obviously, it's a very active bond, because it is a treasury. And if somebody wanted to buy the bond, obviously, I'm not gonna go out and buy bonds this morning, but you could, buy $1 million worth of bonds, click on the buy ticket. That's really it. And in the weeks to come, I'll do more of these, right? In the weeks to come, I'll do more of these. And this is, I just searched for American Telephone and Telegraph bonds to give you a different example. Let's look at Coca-Cola, very safe bond. Let's look at Tesla. So I hit is Tesla, TSLA, that's the symbol for Tesla corporate. Go. Here we go. And these are some Tesla bonds. So we have Tesla 2 3/4 of 22s. Let's look at these. The Tesla Energy Operation, they pay 5.45% out to 2030. That's a description of the bond, the issuer information. There is the bonds that are being traded right now. Trading at 88 cents on the dollar. Obviously, when Tesla issued these bonds, this became a lot more risky. So buyers are paying a discount. It's a risky bond. Here's more quote recap. It's when it's traded really recently. So, and you can even call up the prospectus if you wanted to. And you could read the prospectus, which we're not going to do today. So this Bloomberg really gives you a lot of information if you're a bond trader. Called Solar City is an offshoot of Tesla. Solar bonds. So that's why they're a little more risky, you notice. This is really a good chance for you to, kind of learn how the Bloomberg works and also see how an actual trader will look at a bond. Okay. Example of it. So there's some Tesla bonds. That's actually Tesla. It's convertible bond. All right, so I'm going to stop here, close this up, and that's going to wrap us up for today. Great talking with all of you. I want you to use this. Remember, the keyword would be here is ocean. And any other questions you have, please let me know. Who's here for you. So good luck, and we talk to you soon. Contact me with anything you need. Thank you.